Hi, it's Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is Thursday, April 30th. I'm recording this at 3 p.m. London time. We are getting close to the end of the month. We will soon see if it's time to sell in May and go away, or whether markets have more of their incredible run in store as we moved into the fifth month of the year. Before I kick off with the slides, I just wanted to make some announcements about some exciting Markets Happy Hour news in the weeks to come. We are going to be doing a live event in Singapore on May 6th. That is in the Central Business District area, and it's going to be at 11 o'clock in the morning. And there's an invitation available to anyone who would like to reach out to us. Secondly, we're going to be doing this that same week. A special guest, Christina Hooper from Man Group. She's a strategist there, a wonderfully rich presenter. That's going to be our regular scheduled podcast on Thursday. I'll be in Sydney then the following Monday, and we are going to be having another live event in Sydney's Central Business District. That's again in probably early afternoon there. And we'll be inviting local thinkers, investors, and general market commentators to that. So again, if you're in Sydney, ask us for an invitation, and we will be providing both live recordings on our regular stream. So that takes us almost to mid-May. So with no further ado, let's bring up the slides from today and kick this off. This podcast a change of the guard, as the obvious change of the guard has taken place at the head of the US Fed. That is, Jerome Powell is no longer chairman, but he is staying on as a governor. Somewhat unprecedented in terms of expectations there, but it'll be very interesting to see that now that he will be, we had the comment last week that he was always a chair, not a chief, and that we have to manage expectations as to the influence that the incoming chair will have, given he also will be a chair and not a chief. But it is not insignificant that the former chair, Jerome Powell, is staying as a governor and will no doubt continue to have a long arm of influence there over Fed policy. I would suggest that that influence is going to get around the careful telegraphing of communication around what the Fed is likely to do, and a no surprises policy. As usual, we will cycle through inflation, interest rates, geopolitics, equity markets, and a little touch on other asset classes today. And the subheadings are around, we're still talking about inflation, and oil has hit a new high, even since these slides were made. And we've had the Fed commenting about inflation misbehaving, which is exactly the pattern that we've been noting over recent weeks. I'd say the economic vibes are mixed. We've had some absolutely staggering corporate earnings, particularly for the tech sector, but continue to hear about on the street, the main street suffering when it comes to the economy. When we speak about the change of the guard, we'll ask whether expectations have actually changed with that in terms of the trajectory of interest rates. We will digest some of the earnings that have come out of equity markets and always speak about portfolio implications for that. So when it comes to inflation, I think it's important to think back also about the expectations for inflation, not simply about the numbers as we are reading them. We've commented before that the numbers that come off are typically somewhat distorted. They are backward looking. They may be incorrect in some cases and need revision. And certainly they will perhaps show where the lead, the dominant influence of those numbers comes from. And we also know that food and oil have been distorting some of the headline number over time, and that we need to sometimes strip that out. But when it comes to expectations, it's interesting how expectations can be self-fulfilling. And to take Japan as an example, it is important to remember that Japan has struggled under a deflationary environment for many decades. And this was a struggle in their case to simply generate any inflation. Deflation was destroying asset values and generally not stimulating much economic activity, very low interest rates in response to that. And here we can see that in Japan, their core CPI is back below 2%, unlike prices in other developed markets, with Japan there being the blue line on the top left. And what we can see is that even despite the fact that there have been consumption tax hikes in Japan twice over the past 25 years, that only causes an initial spike, and then inflation tends to settle back to its trend line, and it's still below 2%. So definitely quite a distinctive muted nature of inflation in Japan, again, because expectations are perhaps not around price rises, whereas expectations of high inflation can drive spending habits, which can in the short term drive prices even higher. The second chart shows that when we look at the spoils of war and how Iran has transformed expectations of the ECB, what we can see in this is, again, if we were to compare the Bank of Japan with the ECB implicit rate for the end of this year, we can see that the Iran war has had a direct effect on what the ECB is now expecting, whereas inflation was hovering below 2% in the Eurozone at the time of the breakout of the war in Iran. We can see that it is now getting closer to 2.5% and even going close to 2.75 by the end of the year. So it was notable that the ECB had already halted its interest rate cuts, but the one thing that was preserving the Eurozone from a stagflationary outcome was the fact that inflation was exceptionally low, and that was also taking some of the pressure off the European consumer. If the European inflation starts to tick upwards, some of it driven by energy prices, particularly as we move into winter, that is likely to continue to place stress on the European consumer. If we look at the components of inflation, we are seeing Brent not only hit a high today, we're seeing over $130 a barrel, but also as we look to the December forecast, it looks like this price will be sustained. I've seen the taco being replaced by nacho, which is the sense that not a chance the Straits of Hormuz will open. So if there is not a chance they will open in the near term, and we know that the geopolitics continues to percolate around that this would certainly be negative for oil prices in the sense that it would drive them higher, negative for the consumer of the oil prices, that is. And we've also heard not only about the impact on oil, but also other commodities. Agricultural prices now are at a 30-month high, according to the Bloomberg Agricultural Commodities Index, and that will all filter in to higher sticker prices, not only of fuel, but also of food. Moving to the Fed, we discussed last week the change that was coming there in terms of the confirmation hearings of Kevin Warsh. And we know that there is an increased focus on the balance sheet here as the war rolls on. We now are hearing that the Iran war has cost $25 billion, according to the Pentagon official. So clearly the use of missiles and defense interceptors here have increased, and this is placing increased pressure on the federal purse. The comment around Powell's latest press release is that he is really staying the course in terms of maintaining a careful communication, but he is also, they've decided to hold the rate steady. I did make the comment about the inflation being unmanageable or misbehaving, but now we can see that rate change expectations have been moving. There's now an expectation that there may actually be hikes instead of cuts when it comes to the future outflow. We can see just the difference in one day between the 28th and the 29th, that we've moved from having no expectations of hikes to having some expectations of hikes, and overall for 2026, no change is the dominant expectation. When it comes to equity markets, we have seen some interesting trends in that not every stock has been doing extremely well. We used to speak about meme stocks and how certain stocks, for no apparent grounding in valuations, have performed extremely well. We can see here that Bill Ackman's stock picking fund, which he had been, I'd say, aggressively touting on social media and certainly generating interest in his own persona, had opened down 16% in its trading debut. So not, I'd say, in just non-discriminate buy anything approach on the part of stock pickers today. It's also the case that the drive into equities and that strong sense of FOMO around any discount in the equity market or any sell-off in the equity market has been driven by the fact that bonds have not looked like particularly good value today. There have been exceptionally tight spreads. I think as we show that how tight the spreads have been, this has generally been driving funds into equities as one of the only sources of growth in a portfolio, particularly with that misbehaving inflation that we mentioned earlier. Last week, we spoke about the focus on earnings, and this week we have a little bit of a deep dive into some tech stocks that I was asked to comment on for a BBC TV appearance that actually never happened. But nonetheless, I did a little bit of work on those tech names, so we will talk about that. But as we know, forecasts for the full year have surged when it comes to earnings. Certainly revenue growth was also in the expectations. That has generally been delivered upon. The question would be whether expectations were so priced for perfection, whether that has led to some disappointment when the actual strong earnings and revenue do not meet expectations. We can also see in the US that profit margins are hovering at their all-time highs. All of this points to strong pricing power, strong moats on behalf of certain companies, as well as less inflation than we might expect at the cost line. Perhaps some of that has been due to layoffs, some of that due to either stockpiling inventory in advance and them not having to yet pass through the higher cost of goods, and also a lower call on cost of labor, because as we know, the constant dialogue and narrative around jobs has been that there hasn't been much leverage in the labor component of the cost of capital, that they have not been asking for pay rises, and generally salaries have not been rising. When it comes to risk, we can see that there has been a surge in the not only in the US profits, but on MSCI ASC World profits on record, and the greatest increase outside of a recovery from a recession. So even though we didn't have a recession, it seems like the market is behaving as if we did, and as if we are returning from one. The chart on the right shows that the run up in the S&P has looked quite like certainly in terms of infotech and semiconductors, has looked quite like what was the case in 1998. We know that did end in tears ultimately. And that would suggest that we are looking at some kind of a disappointment on the horizon going forward. So this chart only looks at 1997 to 2002. And what we saw there is infotech had a kind of a peak, and then a dramatic fall from that peak. And that this, if we were to take the semiconductor index, that looks very like what was occurring in the run up to 1999. So having that comparison certainly is a reminder that we are looking at strong market results, and that we need to be mindful of what could potentially lie ahead in terms of technical factors. Now moving to 4 particular stocks that were mentioned as for me to speak about when I was due to speak on the BBC. It was just before earnings were released for 4 key tech stocks: Microsoft, Meta, Amazon, and Alphabet. Those 4 stocks alone represent 18% of the S&P. So this is back to that conversation we've had for some time about concentration, how the top 10 stocks representing 40% of the S&P, these 4 stocks alone, almost 20%. And when I looked across the forecasts for what they were about to, these quotes are from ultimately what they did post, but I was seeing that in every case there was a strong expectation of again good telegraphing of strong revenue growth, as well as strong cloud growth, and question about AI spending persisting. So when it comes to what was actually the proof of the pudding, we know that just going across the 4, Microsoft had shown strong cloud growth, again exceeding expectations, but questions about the returns persisting. Meta had experienced a 5% fall, even though that they had shown, again, strong revenue projections, but they had seen that the capital expenditures were drifting higher, 10 billion more than they had expected. And this, even for a cash-rich company such as Meta, that was showing strong advertising returns and strong returns, say, in its video segment, was starting to experience the cost of compute being a lot higher than it had anticipated. Strong cloud growth again coming out of Amazon, double-digit growth, and web services being a strong part of that. Again, beating analyst estimates, a jump in revenue, and a sharp increase in profit. And then a staggering 81% jump in profits from Google. So beating expectations. And the comment I think is notable here, I would say flag this comment, because we will see more like it, which is Chief Executive Sundar Pichai of Google saying that artificial intelligence is lighting up every part of the business. So is not only driving cloud storage, obviously the use of tokens, the constant use of compute, driving cloud demand for cloud, but also the AI, which is obviously empowering much of the search feature, the advertising feature, and many other aspects of Google. So clearly also their Gemini actual LLM is another strong growth driver. So let's watch to see AI lighting up other parts of businesses going forward. And that's why there has been really a sense that investors cannot afford not to be exposed to some of these trends. Moving into semiconductors in particular, there seems to have been a particular surge in semiconductors, and this was a trend that's been picked up by a few commentators this week. The supply chain disruptions in semiconductors have given them, of course, pricing power, and whereas there isn't much, they're not really discretionary purchase for the demand side of the equation there. Their share of the S&P has quadrupled since ChatGPT was launched, and that's again another notable factor in terms of just where the mood music and I suppose the heat map has shifted to when it comes to equity sectors. And their earnings forecasts have kept pace again. Again, part of that regarding just their pricing power, a somewhat inelastic demand for them, regardless of the price. So this would be, again, part of that artificial intelligence lighting up every part of the semiconductor supply chain. Looking at the US relative to other markets, it is now again the case that we are back to US exceptionalism. We mentioned that before, whether this was a reaction to the Iran war or whether this was in fact now the norm, and that any aberration would any other stock market outperforming the US would only be an aberration. If we are comparing the MSCI EFE US and emerging markets index, they have all done somewhat quite well since Liberation Day, but the US has very much outpaced. The emerging markets have seen the most volatility since the war. They had been at quite a high in the run up to that. We do know that they are most exposed to the energy coming out of the region, and also perhaps a little bit more out there on the risk spectrum. So when risk was not risk off, but at least risk was returning to more familiar assets, geopolitics clearly did not shake the demand for US equities, but perhaps it shook the confidence in countries outside the US. Other comments that actually these are slides from last week, just in terms of the why US remains exceptional. We know that there had been some gains in the dollar in the immediate aftermath of the war. That generally has settled back to where it was before. The war has not now driven any increased demand for US assets in that sense. However, as a terms of where they're trading, the cyclically adjusted price earnings multiple, the CAPE multiple of the US continues to be high relative to its history. Not as high as it has been. It was higher around 2000, but it is still certainly over the average. And the S&P, from a PE perspective, continues to outstrip the MSCI All World. So that again signifies the difference in the trading there. A comment I wanted to make regarding the sentiment and what the geopolitics make it, how that changes investor sentiment. We've noticed that the banks have performed very well. They have seen strong demand for their trading. Some of that is described in the Financial Times as Goldman Sachs retains a knack for spinning anxiety into gold. Clearly, as stock pickers who may be inclined to sell on the sell at high and maybe buy the dip, they can certainly generate more trading that way. Generally, we would be advising managers, investors, to stay the course and not try to engage in volatile trading. But we have also seen that institutional investors have been returning into Bitcoin, which has seen more demand as the Iran war has ignited the rally. So clearly, Bitcoin again representing a very strong risk-on type of an investment. And then also when we look at the private credit segment, a final comment on that. Not only are we speaking about investor anxiety being exploited, we now have managers such as Ken Griffin suggesting that retail investors do not understand private credit, and that is the reason why we've seen these sell-offs in the quarterly funds. I would say there is some truth to that. My argument is that I don't think it's retail investors that have been selling private credit. I think these instructions have generally come from advisors who perhaps have lost conviction in the asset class. And if they've lost conviction in an asset class and are seeking liquidity there, I would suggest that it was never the right asset for that part of the portfolio anyway, that a quarterly liquidity fund should never be relied upon for liquidity. So that is our short set of comments for this week. I look forward to seeing you on the road next week for a conversation with Christina Hooper next Thursday, and on the road again the following week. Thank you for listening to the Markets Happy Hour podcast.